The United States stock market is currently closed, and as of the final closing bell on June 23, 2026 at 4 p.m. Eastern Time, SoFi stock finished the trading session at $17.29 per share, showing an intraday gain of 1.11% on a massive trading volume of over 85 million shares. Most people treat this company like a basic regional bank or a hyper-volatile fintech stock that moves purely on short-term retail momentum. But behind that surface-level number, the real story is institutional accumulation. Big funds are silently swapping their traditional allocations for a piece of this multi-pronged ecosystem, choosing it over classic names because of its integrated technology loop. While retail traders scramble to pick the next daily winner, Wall Street is recognizing that this company is building an invisible layer beneath the consumer finance infrastructure that competitors simply cannot replicate. The expectations are that this asset will remain a volatile, speculative play, but the fundamental reality is that it is executing a structural shift that changes how we view corporate scale. On June 23, 2026, the stock opened at $16.74, hit a daily high of $17.68, and consolidated back to $17.29 by the close. Just look at the trailing months where it traded below $16 and then pushed back up toward $18. This volatility is a playground for those who love online investment options, but it represents a deeper structural shift for long-term allocators. For context, look at how the broader markets operate today. People flock to massive names like Tesla stock or Apple stock when they want high liquidity and steady market presence, or they bet on massive secular surges like Nvidia stock when semiconductor demand goes through the roof. Yet smart capital is moving into fintech infrastructure because the risk-to-reward ratio at these price levels is becoming highly compelling for forward-looking portfolios. Think about how someone builds a long-term plan. If you are setting up accounts with Schwab Intelligent Portfolios or exploring various automated online investing platforms, you notice that modern asset allocations are looking for financial names that are not tied down by expensive brick-and-mortar locations. The modern individual brokerage account is no longer filled with just boring legacy banks. It is adapting to accommodate high-velocity financial technology platforms that scale without proportional overhead. Institutional block trades have been picking up steam over the past 2 quarters, signaling that large-scale asset managers are building structural positions. Looking at recent tape action, the daily trading volume regularly pushes north of 70 to 80 million shares, eclipsing many of its mid-cap peers. This suggests that the stock is becoming a core piece of self-investing strategies globally. When regular individuals decide to invest online, they want a platform that offers them everything under one roof. The retail demand for high-yield savings accounts, individual retirement vehicles, and automated asset management has led to a flood of new users into the ecosystem. If you browse through popular investing sites, the debate is always whether this company can sustain its growth without seeing its loan default rate spike. Traditional analysts look at the net interest margin and assume it will face the same compression that legacy institutions deal with during rate fluctuations. However, the reality is completely different. Because they possess a fully digital framework, their operational costs are a fraction of what a normal regional bank carries. This structural advantage gives them the flexibility to offer higher deposit yields while maintaining healthy corporate profitability. Let's look at the competitive landscape to understand the sheer size of the addressable market that this company is chasing. When people search for investment help, they are often overwhelmed by the choices. You have heavyweights like Fidelity providing an array of Fidelity investments, ranging from specialized Fidelity ETFs to long-standing Fidelity mutual funds. A user operating a Fidelity brokerage account or using Fidelity wealth management services expects institutional-grade execution, comprehensive tools, and stability for their Fidelity IRAs. Millions of people interact with the financial markets daily through the Fidelity mobile app and the robust Fidelity trading platform. To compete in that space, an upstart cannot just be a basic website. It has to be a comprehensive financial center. That is precisely why the SoFi trading platform has evolved to offer robust features for everyday users. Through SoFi Active Investing and the customized SoFi Robo-Advisor, users can navigate the markets without switching providers. When someone sets up their personal SoFi investing profile to purchase SoFi stocks or look into specialized SoFi ETFs, they are engaging with an app that handles their paycheck, their mortgage, and their equity investments simultaneously. This level of cross-selling is something that traditional platforms struggle to mimic because their legacy systems are heavily siloed and built on disconnected architectures. Think about how other digital platforms handle this exact user experience. Look at Robinhood and the massive culture surrounding Robinhood stock trading. The simplicity of the Robinhood app drew in a whole cohort of young investors who wanted clean interfaces for Robinhood investments, frictional trading in Robinhood crypto, or convenient liquidity features like Robinhood Cash Management and Robinhood Fractional Shares. In a completely different tier, you have heavyweights like Interactive Brokers catering to institutional professionals who require advanced Interactive Brokers trading capabilities. Professionals choose the Interactive Brokers platform because of low Interactive Brokers fees, seamless Interactive Brokers account access, and institutional-grade Interactive Broker stock trading tools. Now, where does our primary subject fit into this spectrum? It sits right in the sweet spot between ultimate consumer simplicity and comprehensive banking stability. By operating as a chartered bank rather than just a brokerage layer, it can use consumer deposits to fund its own lending operations. This means it does not have to rely on expensive third-party credit facilities to issue personal loans, student refinancing, or mortgages. It captures the full interest spread, turning every single dollar deposited into a highly efficient engine of profitability. Let's take a quick moment right here for some direct community feedback on this asset. Comment below how many shares of shares of SoFi you currently hold in your portfolio and what your average cost basis is right now. Hearing your perspective helps paint a real picture of where retail sentiment stands across the board. Now, when you look at the fundamental business model, you see that the company operates through three core segments, which are financial services, lending, and the technology platform. The technology platform, driven by Galileo and Technisys, is perhaps the most misunderstood part of the entire enterprise. It essentially serves as the back-end processing infrastructure for other fintech firms around the world. When other consumer applications want to issue cards, manage digital accounts, or process payments, they frequently use this technology under the hood. So while retail investors are hyper-focused on quarterly student loan refinancing volumes, the true long-term value is accumulating in this infrastructure play. The expectation was that high interest rates would completely destroy loan demand and grind the business to a halt. The reality, however, is that their financial services segment has grown rapidly, driven by an influx of high-quality direct deposit members who bring sticky, low-cost capital to the table. Let's look closely at past data and historical context to see how we arrived at this current $17 level. A few years ago, critics claimed that without the massive tailwind of student loan extensions, this company would never achieve sustained profitability. When the stock was bouncing around single digits, the general market consensus was filled with skepticism. Fast forward to recent quarters, and the company has consistently delivered consecutive quarters of positive net income under generally accepted accounting principles. This transition from an unprofitable growth story to a fundamentally sound, self-sustaining financial institution is what caused the stock to climb toward its 52-week high of $32.73 before consolidating to its current level. This performance highlights the divergence between public perception and operational execution. Traditional analysts kept evaluating the firm using metrics reserved for legacy banks, completely missing the scalable nature of its software ecosystem. When you look at an intelligent portfolio strategy, you have to look at the underlying unit economics. The customer acquisition cost drops significantly every time a user signs up for an individual brokerage account or uses a credit card after initially joining for a high-yield savings account, driving operating leverage up. Looking out toward the final months of the year and into the future, the outlook is defined by several critical catalysts and prominent risks. The macroeconomic environment remains a double-edged sword for the company. If the central bank cuts interest rates too quickly, the net interest margin on their massive deposit base could compress, putting pressure on short-term banking revenues. On the flip side, lower rates would ignite a massive wave of refinancing activity for personal and student loans, which has historically been their most lucrative segment. Additionally, the technology platform needs to show accelerating enterprise customer growth to justify its current valuation multiple. If enterprise adoption stalls, the market will re-rate the stock down toward a standard bank multiple rather than a premium tech multiple. Conversely, if they successfully sign major domestic or international traditional banks onto their core processing infrastructure, the upside potential could easily challenge past all-time highs. The tension between what the market expects and what the financial reality delivers will continue to dictate the daily price action. Managing this balance is what makes this asset one of the most heavily discussed names across all major trading networks. To wrap it all up, the contrast between expectations and reality on this asset is starker than ever before. While the general narrative focuses on simple student loan trends or short-term retail trading sentiment, the actual data points to a highly resilient digital banking infrastructure that is consistently taking market share from legacy institutions. Finishing the June 23, 2026 session at $17.29 after an 85 million share trading day, the stock is clearly consolidating for its next major directional move. Whether you manage your capital through traditional firms, utilize automated asset management systems, or build your own custom allocations in an individual account, understanding the underlying mechanics of this digital ecosystem is essential. The market will always have its doubts, but the hard numbers and consecutive profitable quarters speak a language that is becoming impossible for Wall Street to ignore. Keep a close eye on the upcoming institutional filings and volume trends, as they will provide the ultimate confirmation of where the smart players are heading next. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you. Don't forget to like, comment, and share this video to support the channel.